Yes, let me introduce our speaker of the day, Mark Burnett, who is our Senior Vice President for Customs in Europe, the Middle East and Africa, and Asia Pacific. Maybe you have seen Mark before in one of our other webinars because we organize them regularly. So Mark has a lot, like over 30 years of experience in customs and international trade. He and his team are on top of all of the many changes in the customs and trade landscape to help our customers stay resilient amidst all of those changes. Then there is me. I am the Global Communications Manager for Road Logistics, Customs, and ESG, and I will be your moderator of today. So now I would like to share some housekeeping rules for today's session. The presentation will take approximately 45 minutes, followed by 15 minutes of Q&A. The recording will also be shared with you after the session, and we encourage you to share any questions that you may have. On the next slide, you can see where exactly you can drop your questions. So that it can be done in the top right corner in the question box. The other participants do not see the questions that you drop there. We can see who is asking the questions, but of course we keep that anonymous. Also, good for you to know, in the top right corner, you can enlarge your screen. And in case you have some issues with the audio, we suggest that you change your settings to the default device in the speakers. Okay, so lastly, we still have a disclaimer to share. It's a lot of text. This is something that our legal department tells us to do. But okay, to summarize it, we put together the content of this webinar based on the latest knowledge available to us. And we hope that it can support you in your decision making. Basically, what is stated here is, in a nutshell, that Kuehne+Nagel cannot be held accountable for any potential consequences of decisions made based on information in this presentation. So that being said, all there's left to say for me is that I wish you a nice webinar experience, and I hand the floor now to Mark.
Yes, thank you very much, Elise, and also from my side, a warm welcome to this another edition of Trade Talks, centering around the latest changes pertaining to the EU customs reform, which also has a projection towards what we call the European Green Deal. As you can see over here on the agenda, the EUDR. We'll be explaining the background and also how it will be applied. And last but not least, CBAM, something which you would be familiar with in recent months and years, also pertaining to the said Green Deal. Last but not least, at the end, we do have a section where we would provide some insight as to how you deal with these topics, which are, suffice to say, very complex in itself, and how to apply, and also key takeaways from supply chain perspective and also sourcing and distribution. But without any further ado, let's go to the first section, the aforementioned EU customs reform. What will change? For those of you who have been reading on social media what the EU Commission has been trying to do from an objective perspective, you can see actually here the comment by the EU Commission as stated in 2023. One of the main objectives is to simplify the customs clearance procedure with a heavy emphasis on e-commerce. And you will notice that there's also a new terminology introduced by means of stating and rendering the so-called trusted trader, so to speak. So these are new objectives, and you might wonder why this is being done by the EU Commission, because just recently, a couple of years ago, the EU had introduced what we now understand as the Union Customs Code in 2016. And at the time, it was deemed as the most proficient and modern code of its kind, and it would last for years to come. Enter this new regulation or this new reform pact or act, you would see the background as such that the EU Commissioner said, well, whilst certain elements in customs clearance have been updated with regard to the new Union Customs Code, if you look at the sheer volume of trade pertaining to the EU in terms of declarations, one would then also understand that something has changed indeed since recent years, especially with regard to e-commerce, where you just see in 2024 around about 4.6 billion worth of low value consignments, those consignments lesser than 150 euros per shipment, have been introduced, which substantiates an increase of 12 million parcels per day, which is a stagnant increase of volume. If you look at the percentages and the risk associated, there is indeed a red flag. So you could see the number of here, 65% of parcels introduced within the realm of e-commerce were indeed undervalued. So with the initiative to reform the EU Customs Act, the EU Commission is also clearly saying that they want to increase the revenue, which they, as per estimates state, will be estimated around about 1 billion per year. If you take a step back in terms of how much customs contributes to the overall budget of the EU, is around about 10%, give or take, based on numbers as you see on the bottom line, with countries as stated in the graph over here. But the main takeaway is, because of the e-commerce situation and the sheer volume of trade coming in, something's got to give, and that's exactly what the EU Commission is stating here. Another key element which one has to observe is the so-called introduction of a unified European customs data hub. What does that mean? On the right-hand side, we're kind of saying it's kind of like a big brother of customs, because gone are the days of national customs authorities dealing with customs declarations. Enter a newly established customs data hub, which will then replace the requirement to file customs declarations. Traders would then have to file customs data sets. So there's also a change in the paradigm, actually, from a filing perspective. That will be also combined with the increased usage of AI to support risk assessments. And the advantages, so quote unquote, the EU Commission is, as opposed to having a multitude of different agencies, you would have one single agency, one data hub, which is in itself, from a customs perspective, also connected to associated agencies. So, for example, traces, which you today have to file individually next to customs. With that data hub, the EU Commission is also providing for other agencies like OLAF or EPPO or Europol to access the data in terms of what traders have supplied and submitted in terms of the import and export declarations. So there's also a visibility which comes with this single one-stop shop, which of course raises concerns from a data protection perspective. To support the one-stop shop, the EU Commission is also introducing a single EU customs authority. You will notice that today, under the UCC, in the EU27, you are dealing with individual customs authorities. Now, this newly established entity will deal internally with these EU27 customs authorities to support and coordinate data flows, to support risk management, and also to further integrate the 27 individual customs systems which are right now prevalent in the EU, and to promote the so-called one-stop shop, as mentioned already in the previous slide. So it has a very stark emphasis on the coordination factor with regard to the EU27 customs authorities. It will not interact, however, with traders themselves. The EU customs authorities will only interact with the national customs authorities. The traders themselves will communicate with the single one-stop shop EU data hub. For those of you who are familiar with AO, we have a new terminology, as mentioned at the beginning, the so-called trust and check trader. What does that mean? We all have understood in the days of the AO that for the longest time, customs authorities have introduced the notion of having a preferred or green lane, so to speak. If you look at the current landscape, that really hasn't been introduced so far. But with the promise now, the EU Commission has said, we will reinforce the notion of having a privileged entry point or exit point into the EU with the introduction of a trust and check trader. It is in principle an AEO regime. You could call it maybe AEO plus. However, it will replace the current AEO C and S, C for custom and S for security, as pertaining to the existing UCC customs law. With that, you would have privileges like fewer controls, the ability to self-declare, and also to release for transit. Similar privileges you already have today, so one could also ask the question, why this change? This still has to be answered and responded to by the EU Commission. However, for you, important to understand that AEO simplifications will be revoked by the end of 2037. That's still a long time in the future, but is something which traders and importers and exporters have to reckon with. Coming back to the e-commerce side of the world, the EU Commission is introducing a new terminology called deemed importer. This is an interesting one, because if you look at the Union Customs Code as it presents itself today, there's no mentioning of an exporter or an importer. One would find the term as a declarant. So why the change? Again, looking at e-commerce with the sheer volume being introduced into the EU, most of the e-commerce shipments is facilitated by so-called marketplaces. So we all have seen the Amazons or the Alibabas of the world. With that comes a certain challenge with the undervaluation of customs, so not paying any customs because of the existing de minimis threshold of 150 euros, and also the abolishment of not having to charge any VAT. That is now going to be changed because those marketplaces, as already mentioned, will be regarded as deemed import, and as such will be fully liable for customs, duties and taxes, and on top of that for product safety. So the takeaway over here is the 150 de minimis threshold will be abolished. Also, what will be abolished is the so-called temporary storage, which today is 90 days. It will be reduced to 3 days, after which marketplaces or deemed importers have to decide what they want to do, either re-export or clear for free circulation. So it shifts away the burden for the individuals more to the marketplaces being liable now, as opposed to today where they're not liable for any duties and taxes for goods entered into the EU. A simplification most certainly is the topic of classification. So as an importer, you would know when importing into the EU, you would, amongst the custom valuation and the origin of goods, you would have to file with customs declaration, the so-called classification of goods, so the categorization of such. With the EU custom reform, the EU Commission is introducing a so-called bucket list. It means that you would not have to categorize or classify, as you say in customs, each and every single commodity. You would just have to make sure that your goods somehow need to match the categorizations as pertained or as listed over here. So, for example, if you have pharmaceutical goods, you'll be in the item C. That would attract 8% duty level. If you introduce footwear or beverages, it would attract a duty level of 70%. That indeed is a simplification, as opposed to now having to clear goods and classify goods based on the nature and the substance of the goods, which in turn would mean that importers would have to have in-depth knowledge of classification, which is a very technical aspect. In terms of the schedule, there are actually 3 phases. It starts actually with the Big Bang in 2028. So that is the phase where marketplaces will have to register as deemed importer. They would also have to register for VAT on the IOSS, so the single one-stop shop for VAT. They would be liable for duties and taxes and product safety. In 2032, all traders, i.e. all those traders situated in the EU, could register for the data hub, so the ability to communicate with that single entity. And in 2038, everything becomes mandatory. Then the environment is changed in so far that importers and exporters would have only one single entity to communicate with, and that would be governed by that newly introduced EU Customs Authority. With that, we closed the first section of the EU customs reform, and let us now take a look at EUDR. So what is EUDR? You see a graph which kind of insinuates what this is all about. It has something to do with the European Green Deal. And this is an interesting statement coming from the EU Commission, which was posted in 2019, where the EU Commission has set itself up for being or becoming the first climate neutral continent in the world by 2050 by introducing so-called mechanisms to govern the way commodities are dealt with being introduced from non-EU countries into the EU. So the Commission calls it the man on the moon moment. Let's see what this is all about. So the bigger context, the Green Deal is nothing new. For those of you who have been around in trade already 20 years ago, you would recognize that or remember that with the introduction of the Energy Tax Directive, ETD, that was actually the ground zero moment for the Green Deal from a taxation perspective. Then in 2005, the EU introduced the so-called emissions trading system, ETS. With that, this is now supplemented with the so-called Deforestation Regulation, so EUDR, which was introduced in 2023. And last but not least, the so-called Carbon Border Mechanism or Adjustment Mechanism, which was introduced in 2023. The latter part we will touch base in the next section, but let's focus on now the EUDR Deforestation Regulation. So again, for the context, why have the policymakers introduced this new set of regulations pertaining to the deforestation of and environmental issues? If you look at the graph over here, you would recognize that in recent years, the EU has set up an array of different procedures, all governing sustainability. So from a timber regulation perspective or FLEGT action plan, everything is touching with regards to sustainability, environmental issues, and especially with regards to emphasizing reforestation efforts. These are all efforts being executed in the EU. There's no level playing field because companies or countries outside of the EU don't have these stringent measures, which puts traders in the EU at a disadvantage because all of these initiatives comes at a cost. So what to do? Enter the regulation, and you see the objective over here is to introduce a due diligence into the value chain or supply chain of relevant commodities. What relevant commodities I'll be showcasing the next slide, but let's just take a look at the objectives. So you see here the wording is promote, reduce, and protect. Promote supply chains, making the supply chains free of deforestation, reducing the EU's contribution to greenhouse emissions, and at the same time was doing the first two elements, protecting human rights associated with these supply chains, with certain commodities which are governed by this new regulation, and associated people, i.e. indigenous people, in the originating countries. At the same time, the UDR also combats agricultural expansion. So again, there's a high emphasis on sustainability here. The measures put in place are again three items: prove, ensure, and submit. Importers need to prove that their supply chain, their commodities are free of deforestation measures. Secondly, importers need to ensure that production is in compliance with this regulation. And by the way, not only from an EU perspective, also in regards to local legislation. So, for example, importers would need to also make sure that the supplies are in compliance with the local tax law or local human rights law. So this goes way beyond the actual Deforestation Act. And then in so doing, there's a so-called new submission regime called the due diligence statement, which is something the importers can apply for on a website, which I'll be explaining later on in a couple of seconds. What you need to know is from an importing perspective, you would need to file the due diligence statement prior to placing goods into the European single market. The goods governed by these regulations you see over here. So it's cattle, rubber, cocoa, soya, coffee, oil, palm, and wood. Everything is listed in Annex 1. These products are heavily governed and administered by this new regulation. The cutoff date where importers need to be aware of when this kicks in is actually 31st of December 2020. What does that mean? It means if you import said commodities into the European Union and place them on the market post-importation, you would need to make sure that as of beginning of 2021, your product should be derived from an area or country which is no longer deemed as a non-sustainable setup. So it needs to be sustainable, it needs to be in compliance with EUDR. So to make it more tangible, if you import wood, for example, wood cannot be imported from areas which have been deforested post 2021. Same is applicable to cocoa or soya and other prime commodities. The way this works is that the EU has distinguished two new traders. One is the so-called operator and one is the trader. Both are actually traders, but the operator per regulation means that an operator per EUDR is a typical importer who imports, who sources said commodities and brings those commodities or enters them into the European market. The trader is a business company trading within the EU. Both need to operate based on the due diligence statement. So that's a statement importers and traders need to apply prior to placing said commodities on the European market. And from a pure practical and operational perspective, if you're an importer, you would need to not only apply for the due diligence statement on a website, you would also receive, by virtue of the due diligence statement, a so-called new tariff number. So I've placed one over here. You would recognize C716, and C716 is a reference number in alignment with the new tariff codes, which you would have to enter when submitting and filing your customs declaration. What did the customs authorities recognize? They recognize that your commodities are in compliance with the EUDR. Should you not have this number, you would be blocked for importation into the European Union. Taking a look at the submission of the due diligence statement, you would recognize on the left-hand side an excerpt from the EU website. So as an importer, you can register yourself on the website to apply for the due diligence statement. The due diligence statement is actually quite detailed, as you can see on the right-hand side. So next to the description of the goods, the quantity, the CN codes, the country of production from an origin perspective, and the so-called plot of land pertaining to Article 227. Then you would also recognize that you would have to be regarded or state whether you're an operator or a trader, and prove by a certain mechanism that your products are free of deforestation. And above that, that is not enough or does not suffice the policymakers. You would also have to provide evidence that the production and the manufacturing of your commodities you enter into the European Union are in compliance with local legislation. And the latter part is quite challenging because imagine you dealing with a Brazilian manufacturer or producer of lumber, and all of a sudden you be targeted with the obligation to ensure that said manufacturer is also in line with local tax regulations, custom regulations, human rights regulations. It begs the question, how are you going to manage that? Now, the policymakers haven't said any specific tangible elements how they want to check that, but you need to make sure that this is actually in place from an audit perspective. The way the auditors will look at this is that you need to have sufficient record-keeping documents in place, stored back in archive for 5 years. So this is not going away. It emphasizes heavily the compliance initiative with regard to EUDR. When we look at the next to the DDS, there's another initiative you would need to be aware of. So you file the DDS, so this so-called due diligence statement, which, by the way, you not only can file for one shipment. If you have a succession of shipments, you can use the same due diligence statement with the same new tariff coding, as was already mentioned in the other slide. But with that, you would also have to provide the so-called geolocation, again, as part of your submission for customs. The geolocation states the so-called is combined with the HS code, the product description, quantity, enabling traceability. On the right-hand side, you can actually see an excerpt where you can actually provide or receive the exact geolocation of products. You can either use the so-called GNSS or the GIS or any sat nav, which would also provide for the exact location of the production site, which, by the way, has to be so exact that longitude and latitude has to be 6-digit behind the comma. What other obligations do you have? So interesting is Article 8, where the two takeaways. Number one is a filing initiative per transaction. So again, you would have to file the DDS prior to placing goods into the European Union. And when placing or filing your customs declaration, you would have to file the so-called new tariff number. Number two, from an annual perspective, there's a continuous compliance initiative you would have to put in place. Compliance similar to what you might remember or recall in, let's say, from export control perspective in ICP. That's exactly what the policymakers are setting out to, having a similar internal compliance program for EUDR in place, making sure that you have all the records in place, the DDS statements in place, the geolocation sat navs in place to substantiate where you've already you have sourced your commodities, how you've made sure that the commodities and the production of your goods were in alignment with the EUDR regulations. And also you would need to demonstrate how you are actively trying to reduce your risk of breaching the EUDR regulations according to Article number 11. So it's putting a huge strain on importers. Admin will increase, and you will need to decide, are you going to have external parties supporting you in this, or do you need to hire people who are very well versed in this new legislation? From a timeline perspective, there's a transitional phase in which we are currently, and there's a full implementation. There has been an update recently, and so far, because of the sheer complexity of this new regulation, the EU Commission has said, okay, we will provide for an extension, meaning that for so-called large operators, there is a cutoff date, as you can see over here, 30th December 2025. Anything as of then, those large companies would have to fully be in compliance with the EUDR. For smaller and mid-size operators, the cutoff date is 30th June 2026. And for those of you who might be asking, well, what is an SME? Well, there's a regulation which actually explains that. So if you are a company with less than 50 million revenue or less than 250 headcount, you are deemed as an SME. Anything exceeding that, you are deemed as a large operator. What to do? We advise operators and traders to actually reflect on three elements. One is, of course, suffice to say, know your regulations. So it's all about collecting the right information at the right time and processing it in accordance with the EUDR. Then at the same time, one would need to evaluate the risk associated with being non-compliant. So non-compliant is not a topic. As you can see, there are hefty fines which the EU has introduced. So take, for example, 4% of your total turnover, or the exclusion of any public procurement processes, or even more severely, there could be a temporary prohibition of being able to trade with the EU for a certain time if the authorities recognize that you have willingly not been in compliance with this regulation. So it's all about building the mechanism internally to manage it from an operational perspective, but also to make sure that your record-keeping initiatives are in place to suffice the policymakers. Having said that, let's move on to the third section, to CBAM, so the Carbon Border Adjustment Mechanism. So we've mentioned it here kind of like from the transition to the implementation, because this is something I think the majority of traders have somehow heard of in the recent years. It's all about, again, creating a level playing field. And you would recognize there's a correlation between the ETS system and CBAM, insofar that if you are a manufacturer in the EU as of 2005, the EU would have to make sure that the emissions of the greenhouse gases you emit on a yearly basis are in line with the threshold. The threshold itself is reduced every single year. Why? Because the policymakers want to promote companies, manufacturers producing in the EU to be more environmental friendly. That comes at a cost. So, assuming you would be exceeding this threshold, you would have to acquire permits. Permits come at a cost within the cap and trade environment. So you would have to buy permits for those for that tonnage of CO2 above that threshold on the ETS European Trading Market. In relation to non-EU companies or countries, there's no level playing field because what has happened in the meantime since 2005, European manufacturers have said to themselves, well, if I have to pay these tax credits, I might as well produce my commodities outside of the EU and then reintroduce them into the European market, kind of bypassing this regime. And that's exactly what the EU Commission is targeting. Carbon leakage is something which could occur if there's no mechanism to adjust for such. Hence the word carbon border adjustment mechanism. So the way this works is the EU Commission has said, in terms of the Green Deal, creating a level playing field means in principle that the EU Commission wants to prevent said leakage from a CO2 perspective by adding a price tag, or to make it more specific, by adding a duty level on the CO2 or the embedded emissions for products introduced into the EU with a heavy carbon footprint. That is CBAM. The products or the industries which are affected are 6: iron, steel, cement, aluminium, fertilizers, electricity, and hydrogen. Those are the primary industries or product commodities which are affected. However, you would need to know that this is only the starting point. What the EU is actually setting out is to phase out the European trading system for the ETS system, and also by phasing out the ETS by further introducing more products and categories into the CBAM regulation. There is an update, which you can see over here, that the EU Commission said because of the smaller companies not having the infrastructure in place and struggling with this new regulation, that they are contemplating to create a threshold of 50 tons. Below such this value, companies, predominantly SME companies, which represent 90% and plus of all importers and traders importing or impacted by CBAM, you would, as an SME, not be impacted by this regulation. However, this is just suggested by the EU Commission. It is by no means has been ratified by the EU Parliament, which is now up for vote in May, June of this year. In terms of the emissions, there are actually two factors you would need to understand. One is the so-called direct emissions, which have been directly associated with the production of steel, with the production of aluminium, with the production of fertilizers, and also the indirect emissions, like, for example, electricity, which has been used and consumed to facilitate manufacturing of said products in non-EU countries. The difference between the reporting initiative, which was introduced first in October 2023, is that the EU Commission has said as of Q3 2024, all importers affected by CBAM are now obliged to report their actual emissions, which puts a heavy emphasis on getting that supply engagement in place, because your suppliers will need to provide you with direct and indirect emissions for products and shipments which you have introduced into the European market. Who can submit, or who should submit? Either you are an importer located in accordance with Article 5 of the UCC in the EU, or if in the absence of such, if, for example, you're a Swiss-based company and you're not based and don't have a legal entity in the EU, or a UK-based company not having a legal entity in the EU but acting as an importer, you would have to refer to an indirect representative who would act on your behalf, who can then not only file the customs declarations but also act as the CBAM declarant. The timelines which the policymakers have set out is, you can see over here. Again, similar to EUDR, we are in the so-called transitional period. The transitional period is non-fiscal insofar that importers are not required to apply and purchase any tax credits. The big bang will happen as of January 1st, which means any products which are governed under CBAM, if you're an importer, you would have to hedge or buy CBAM credits in advance pertaining to the amount of volume which you were introducing into the EU. The reporting sequence is here that the annual report will substitute the 4 quarterly CBAM reports which you currently have to file up until the end of 2025. So enter 2026, you would have to file for an annual CBAM report where the cutoff date is May 31st. And again, that goes hand in hand with the so-called necessity to acquire CBAM tax credits, which, similar to the ETS system, can be acquired on the spot market in Europe. You would see a red point in 2034 as depicted on this schedule. What does that mean? It means, in principle, that with the phasing out of the ETS system, more and more products are going to be introduced into this realm of products governed by CBAM, which means by 2034, all industrial products pertaining to the customs tariff or the tariff as of as of Chapter 23 will be subject to CBAM. Again, you see the long-term goal here is 2050. By 2050, everything is rolled out, and by then, hopefully, we are CO2 neutral. So, quote unquote, the EU Commission. From a pricing perspective, as mentioned early on, the CBAM certificates, which is, in essence are tax credits, can be acquired based on the EU ETS emissions system. You can buy and sell these certificates. However, as you can see on the right-hand side, the EU Commission has introduced a cap. So if you have more than 33% of an excess of certificates, anything exceeding 33% is a loss, which requires you conversely to make sure that you are very close to your CBAM forecast or your forecasting and budgeting sequence for 2026 and onwards to make sure that you don't buy too much of an excess of CBAM certificates. There is a concession that the EU Commission has made. So if, for example, your suppliers in non-EU countries have themselves paid a carbon price in the originating or shipping country, you can use that price to offset the otherwise due CBAM tax credit you would have to acquire on the ETS, on the European emissions trading market in the EU. So there are some certain concessions. There is also a concession that you can sell certificates back, but again, takeaway here is there's a limitation of the total amount of purchased CBAM certificates. The impact of CBAM can be seen here. So in trade, it's all about landed costs. So assuming you have by commodity based on Incoterm FOB, you would then know you would have to arrange for transportation at a cost. You would have to apply an insurance for the coverage for the shipment, and then you have a CIF value. On top of that, you have to pay duties and taxes and associated costs. Enter CBAM, you would also need to understand that CBAM increases the price of your commodities entered into the European Union. Take, for example, the average steel price. You see on the right-hand side, the price for steel will increase as predicted by a study which you can see over here by McKinsey, which means in reference to the average price per tonnage, which is 1,450, a price could increase as depicted over here, which means in principle, some countries, especially in Asia, might shy away from the European market. Those countries and those suppliers not shying away from the European market, they would continue to deal with the EU. However, from a pricing perspective, traders would have to pass on these costs to their supply chain. At the end of the day, the private individuals, us consumers, would have to pay the price tag. So, as a takeaway, nothing comes for free. Nothing is for free. CBAM, the Green Deal, will come at a cost. If you think that or assume that we are alone from a European perspective when it comes to CBAM, you are mistaken. Have a look at this slide and just reflect on how this might, what notion that this is creating. So you can actually see very quickly that green initiatives, sustainable initiatives, emissions trading systems are not going away, they're actually increasing. Interesting, notice that China, of all countries, which is usually deemed as a country not really focusing on environmental issues, has themselves introduced an emissions trading system quite similar to what you see being introduced already in 2005. This will continue insofar that sustainability is on the agenda and rising. So again, the takeaway here is CBAM is not going away. As indicated earlier on, there are some proposals on the table. So the Commission has received a multitude of complaints, particularly from the freight forwarding, from the customs brokerage, but also from small and mid-sized companies saying this regulation is putting a heavy burden on our working capital, on our administration. We need a simplification. And as mentioned, one of the simplifications could be that a 50-tonnage cap could be introduced for smaller companies. Another simplification could be that with the introduction of a third party, which is contemplated to substitute the indirect representation or the importers otherwise having to file as a CBAM declarant to kind of outsource the obligation of CBAM. That's another initiative, but also the way you purchase and the way the embedded emissions can be reported. So again, currently actual values have to be reported, but there are concessions considered in the new proposal by the Commission to also use default values. However, word of caution, default values will always be higher than the actual values. So if you only think that the default values is easier to use because you can't get hold of your suppliers in Vietnam, in China, in Malaysia, and there's a reluctancy from said suppliers to provide you emissions, you can, of course, potentially refer to default values, but those values are typically 20, 30, 40% higher than the actual embedded emissions. So there, as an importer, you're always advised to use the actual emissions. Again, this package of new proposals has now been forwarded to the EU Parliament. The EU Parliament will debate on this and should the majority vote be in favor of this new proposal, then it will become law. But again, as of now, it is only a proposal. Quo vadis? A lot of information, and we're well aware of that, what to do if you're an importer, a trader, or an exporter. If you're contemplating entering into the new market with products which are either governed by the EU custom reform or the EUDR or the CBAM regulation, what should you do? Well, first of all, again, it's all about understanding the requirements. Know your jurisprudence. Make sure that you're well versed with all of these three initiatives, customs, EUDR, and CBAM. Nothing offsets the requirement to do some digging in terms of the ordinance, but also then understanding and reconciling, if you understand the ordinance, what kind of data is required? How do I process the data? What documentation do you have to apply? We said earlier on it would be advisable to create something like an internal compliance process for EUDR and CBAM. Most certainly for the group, from a Green Deal perspective, it is advisable. Once you have that in place, what do you convey to your suppliers? So from a CBAM perspective, you would recognize that you would require them to give you the direct and indirect embedded emissions. That doesn't come from one day to another. You would have to educate them to have a basic understanding of what requirements are there. You would also need to know how the emissions are to be reported and how the mechanism of emissions extracted from the manufacturers should be provided in a certain format. The emissions themselves have to be, from a CBAM perspective, merged with customs data to create a CBAM report. How do you do that? And do you have a contractual alignment with your suppliers, making sure that legally you hold them liable and they come to the party giving you or seeing the urge for you to for them to supply proactively CBAM emissions data, or in the case of EUDR, providing you with all the requirements from a due diligence perspective, next to traceability, etc., etc. Then from a strategic perspective, it might be worthwhile to reassess your supply chain. So, for example, if you look at the CBAM regulation, you would notice that in principle, CBAM reports can only be filed per country. Now, if you have 15 countries as entry points into the EU, you might want to contemplate congesting all of your inputs into maybe the Netherlands as one point of entry to kind of capitalize from a logistics perspective by virtue of congestion, also on the lesser workload implied coming with only having to file one CBAM report. Then also the question, do you make something? Do you have tools to process all the data? Or do you buy something off the shelf? And also, who's going to advise you on all of these regulations? So getting a sanity check on the application is advisable, next to also contemplating your logistics and maybe rearranging your supply chain in accordance with these new regulations. In any case, trading customs should not be a final mile contemplation. Trading customs should start at a very early stage next to the HS classification, origin of custom value. These regulations are not going away. So when you contemplate entering or dealing with new markets, it's always advisable to have customs a seat at the table at a very early stage to avoid any unnecessary risk exposure and to mitigate risk from a very early stage and have the most sufficient and sustainable supply chain setup going forward, making sure that auditors don't surprise you with any unnecessary exposure. Having said that, a lot of topics, three major topics pertaining to changes in the European Union. I would now refer back to my colleague Elise, because we do have a section where we are opening the floor for some Q&A. So
yeah, exactly. Thank you, Mark. And we have quite a lot of questions. One of them I can answer already myself. So yes, we will share the presentation along with the recording afterwards. And also, if some of your questions cannot be answered in the next 10 minutes, we will retroactively do so and share that link with you as well. That being said, let me quickly go now through the list. I try to the best of my ability to group them a little bit as per the topics discussed. So for the EU customs reform, how to qualify for the trust and check traders status?
A simple answer and response would be the trust and check trader is similar to the AO. There are some additional requirements with regard to data security, ability to also engage with the EU Data Hub, so the newly created one-stop shop. So if you have AO already in place from an AOC customs perspective or an AOS security perspective, you already have a good baseline to qualify for such. The EU Commission still has to substantiate as to how the trust and check trader will be recognized. So I can only advise to be alert with regard to changes in the next couple of months in this year, because the EU Commission has indicated to provide further information and more granularity on what trust and check traders have to do in practice.
Mm-hmm. Okay, so also related to EU customs reform, how will the reform affect the role of customs specialists and brokers?
That's actually a very good question. So, having worked in customs for over 30 years, back in the day, it was all about knowing your forms and your documentation. Those days are gone. Enter a new set of qualification, and certainly one qualification is IT. So, it's not sufficient enough just to know your jurisprudence, so knowing which regulations are to be applied. The customs experts should have a keen view and also data requirements and be well versed in IT infrastructure. So having a meaningful exchange not only with the customs authorities but also with the internal stakeholders, so that the translation of regulation isn't only isolated is only an isolated discussion on which regulations and articles have to be implemented, but also they're showing how to apply it from a conversion perspective.
Okay, and very much linked to that one, will custom specialists need to adopt new software or reporting standards?
Yes, most certainly. So, as you might remember, the EU Customs Data Hub is making the national customs authorities from a server perspective or from a systems perspective redundant. So, you will need to understand how to connect with these customs authorities. And there are two ways how you can do that. Either you build up the infrastructure yourself, which comes at a cost, or you decide to use a proficient service provider who has the infrastructure who has the manpower, the resources, the capabilities, and who are themselves maybe or then later on trust and trader to provide for the entire infrastructure and the maintenance, which should not be neglected. As we've seen in recent years with the introduction of NCTS 5 or other initiatives like ICS 2, every time the EU Commission has introduced new updates, it comes at a hefty IT cost. So being well versed in that is very advisable, and also making sure that you have the capabilities as a company to do that, and if not, refer to a service provider.
All right. Another one related to the customs reform. The new classification of goods, is this only for e-commerce or for other importers too?
This is only for e-commerce. I wish it would be for other categories, but unfortunately, the EU Commission didn't listen to me. No, jokes aside, the bucket list has actually only been set by for e-commerce, so for high frequency business and for high volume business, where the policymakers have recognized to facilitate more revenue income with the abolishment of the 150 euro threshold, so the so-called de minimis regulation. We need to provide a concession. Concession is to make classification easier. And most certainly, if you only have 5 buckets or 5 categories, it is easier. But this only relates to e-commerce.
All right. So here's the question related to EUDR. Would we need to provide proof that our suppliers' material is sourced sustainably?
Yes, yes. So I can only advise to incorporate EUDR into your auditing of supplies. So larger companies do this regularly. When opening up or contemplating a new supply, introducing supply into your value chain, typically there is an engagement. There's an own audit, which happens from a compliance perspective to make sure that the quality meets the expectations. So there's a visit of the manufacturing side, the processes are explained from a supply perspective, etc. Now, picture that scenario and put on top of that already existing auditing of your supplies, EUDR. So you would have to enter a new set of requirements into your already existing cost supply engagement and obligations to make sure that the suppliers understand what you want, deliver what is needed, and are in compliance with the so-called EUDR regulations, which, as we now understand, go beyond sustainability. So we touch base on human rights, we touch base on tax compliance, touch base on customs compliance. So there's a huge bucket list of requirements, which then also on top have to be managed by virtue of an audit.
Mm-hmm. Okay, another one on EUDR. It's a bit technical and a bit long, so I will try to not speak too fast. So in the context of implementing the EUDR, when lodging a customs declaration for exports outside the EU, does customs accept that each exported product can have its own reference number, or is a single reference number for the entire consignment required via the traces system?
So it's not going to be the tracer system. That's a different scenario. But what it will be is that whether it's import and export, you have to file the so-called new tag number. You remember the scene number, which I indicated in the earlier slide, per declaration, and that is always linked to the commodity. Now, the difficulty is if you have a shipment pertaining consisting of a lot of different commodities, is getting that right. A DDS number, which then will give you the extended new tag number in place. So the message is here, it relates always to the individual commodity.
Yeah, okay. Also, another question was, is the EU planning to extend EUDR to additional commodities in the future?
Um, Let me put it this way, I wouldn't be surprised. So you see in the case of CBAM that the EU Commission said it's only going to be 6 commodities. What happened in the meantime, we now know that all industrial products at some point in time, at least until as of 2032, will be additionally governed by CBAM. I would not be surprised if more products would be introduced into this new regulation, which is why, even if you are an industry which you currently are not having to deal with this or not impacted by EUDR, it would be advisable to at least know something about this regulation, because potentially, yes, it could be expanded.
Mm-hmm. And does the EUDR also apply to the online marketplace?
It applies to everything, regardless of if you are looking at e-commerce or if you are in the so-called B2B business. In any case, the product itself has to be registered via DDS, so the due diligence statement, and required geolocations have to be provided prior to entry goods into the EU. Doesn't make any difference if it's e-commerce or not. Only the difference being is that with e-commerce marketplaces will be registered as deemed importer. They would be liable to provide this, and how that's going to work, that's going to be very interesting how that pans out.
Mm-hmm. So now related to CBAM, how should importers calculate the carbon footprint of their products if their suppliers do not provide emission data?
Well, first of all, you might need to contemplate shifting suppliers because that's an absolute no-go. The concession which the policymakers are making is providing providing default values. That's a concession which is currently being discussed, which puts you as an importer at a loss because remember the emissions from an actual perspective are significantly lower than the so-called default values. So that should incentivize you to have a stark conversation with your suppliers and maybe threaten to shift your supply chain and rely on new suppliers or other suppliers who are willing to provide emissions data.
All right, and maybe a final one on CBAM, and then it's time to close off here. So about the single point of entry into the EU, why is there a difference if you import into one or more ports in the EU? And is there the obligation to do the annual report for CBAM per each country where we do the customs clearance?
Yes. Yes, so every time you enter into different EU countries, you have to file an annual CBAM report and also make sure that you have sufficient CBAM tax credits acquired. If you have 10 countries where you import, you have to file 10 CBAM reports. That causes an array of admin, uh, causes resource which you have to provide for from a company perspective. And you also have to ask yourself, do I have the tools, the digital platforms to not only provide and extract custom data, but also merge it with my emissions per country? If you have one entry point and you congest your supply chain, you can not only congest from a logistical perspective, you can also make sure that you have less admin associated with CBAM and effectively also less costs associated because you only have one country where you would import with one initiative to combine all the imports into one CBAM report.
All right, great, Mark. So I can see that our time is up. I just would like to remind everyone that we will answer those questions that we haven't been able to touch on yet, and you will receive a link to those answers later on. So other than that, I would like to thank everyone again for joining us today. Keep an eye out for our next sessions, and have a nice rest of the day. Thank you
Thank you
very
very
much.
much. Bye bye.
Bye.